Welcome back. It was a very good question that was posted on our YouTube page the other day that I think led us to what we're going to talk about today. The question is, what is the best economic indicator, the best economic report to predict a recession? Now, typically, recessions are defined as two consecutive negative quarters of GDP, gross domestic product. That's a number that the financial channels use to define in broad strokes what a recession is. A recession is different for everyone. The economy is made up of small businesses and big businesses and employment and the different types of employment that we have in different sectors, whether we work in the automotive sector or the housing market. What is a recession for one individual may not be for another. So I think that the best way to answer this question is there is not one economic report that is best for defining recession, but rather we try to use a number of different economic reports to properly frame the economy, to look at the economy from as many different angles as possible in order to make the most educated decision. So, for example, we see our non-farm payroll. On the left-hand side, we see non-farm payroll from 2006 through 11. Now, oftentimes we compare present day numbers to that period of time, 2006, 7, 8, 9. It is not at all done because we want to imply that what happened in 2008 with the stock market crash is going to happen again. But this period of time does represent a tremendous array of different economic conditions. We had 5%, I think over 5% interest rates, very, very strong stocks hitting all-time highs in 2007 and 8, followed by a very deep, significant, severe economic recession that brought us down to nearly zero interest rates, followed by a lot of quantitative easing and other Federal Reserve programs. So it really does provide us with an array of a lot of different economic conditions, and we can compare the charts. And the charts are really such a beautiful tool because we don't have to go through a number of very complex mathematical formulas. We very simply just look at the chart. We look at the picture, and it really does show a picture of what this particular slice of the economy look like. So, for example, non-farm payrolls, which measures the amount of jobs created mostly in the private sector in 1 month. And we see here 2006, 136,000, 738,000 jobs were created. Late 2007, 2008. That's on a month over month basis. Now, the stock market we know was actually strong through mid '08 and really started to crash in the third and fourth quarter of 2008, hitting lows March of 2009. The non-farm payroll is a little bit of a lagging indicator. It doesn't react immediately. It kind of trails everything else by nature because those of us working in 2007 and 8, we might not have lost our jobs immediately. For those of us that did, you're working for a company, the economy goes sour, they don't fire you immediately, they don't have layoffs immediately. But as conditions get worse, then we see the layoffs. And then it takes, some time for people to respond to the non-farm payroll survey, and that's why this is a lagging indicator. So while we hit tops in the stock market early '08, this non-farm payroll actually around the same period of time hit those tops as well. But we didn't see a bottom in stocks till March of '09. We didn't see a bottom in non-farm payrolls until late '09. It took some time for those companies to start rehiring. Well, present day, and we obviously know there's a huge spike down March of 2020 as a result of the COVID crisis and the stock market crash that went along with it. Now, non-farm payrolls hit lows of 130,000 on that month and then has been making new highs pretty much ever since. So if we were to overlay the right chart to the left chart, where are we? Well, we're still more or less making new highs, which puts us in this area. Now, it's not to say that we're going to start turn to the downside as we did at that point. I think a better use of this tool is to say, okay, when non-farm payroll started to decline, how did this coincide with the stock market? Well, the stock market was still hitting new highs mid '08. the non-farm payrolls had already started to turn. So take that as a lesson. If we start to see the non-farm payrolls start to turn in the next few months and follow this pattern, we can match it up with what non-farm payrolls look like at that period of time. We see here CPI, Consumer Price Index. Now, inflation has been probably the biggest story in the financial markets for the past year. This is on a year-over-year basis. We oftentimes use a year-over-year basis as a means of analysis because a lot of economic numbers have a seasonality. We tend to buy more homes in the summertime than the winter. Therefore, it's not fair to compare June to February. June, we compare to June of last year. So we see here the consumer price index. We hit highs mid 2008 and then started to turn to the downside. We hit lows around mid '09 after the stock market hit lows a little prior to that. The consumer price index hit highs August, roughly mid 2022, about a year ago, and since then has been declining. But notice that the consumer price index, and not to disregard this number, I think it's very, very important to watch this, but it's a very unusual situation we've had with CPI in particular, because we experienced this COVID crash. And we didn't see, normally you see interest rates go down 5% over the course of a year. If we were to look at the interest rate cuts from 2007 through 9, it didn't happen all at once. The Federal Reserve cut interest rates immediately as a result of the COVID crash, and they did a lot, probably a year's worth of cutting within a couple months, if not less time than that. So when we compare August of 22 to August of 21, we're comparing a very high period of inflation compared to a very low period of inflation. And we saw this dramatic hike in inflation because they cut so quickly. So inflation rose that as quickly as they cut. And that's why we saw such an enormous spike in inflation. But nevertheless, we saw inflation hit highs about 6 months before the stock market really started to crumble. Does that mean that the stock markets will crumble 6 months after that high? Well, that's actually right now. But again, this is only one slice of the economy. It's just looking at, the economy, think of it as like the universe, and we're just looking at it from one specific angle. But according to this angle, we've seen steady declines on a year-over-year basis in terms of inflation, but also, they continue to raise interest rates. They raise interest rates where they were not raising interest rates anymore in 2008. So maybe this inflationary drop is more as a result of the Federal Reserve cutting interest rates and not a result of the Federal Reserve cutting interest rates and the stock market crashing. They're kind of doing the job, for both, just with interest rate hikes. Now, the prior two numbers, non-farm payroll, CPI, those are considered by nature lagging indicators. They move after, things have already started to occur, at least in terms of the stock market. On the other side, we have a leading indicator, building permits, year-over-year basis. Now, when we take a look at the life cycle of a home builder, they want to build a house. Well, they buy the piece of land, then they get the building permit. Now, I don't know what exactly the process is as far as how long it takes for a permit to be issued. If anybody knows, now it certainly would be very interesting information. But we get the building permit far before we start construction and far before the house is built and far before the house is actually sold. So building permits by nature tend to be a very leading indicator. Take a look at building permits, which were positive and crossed into negative territory mid '06. 2 years before the stock market started to crumble, building permits are already on the decline. If we had a stock market trading strategy based only in building permits, well, we probably would have done very poorly selling short between 2006 and 2008 because the stock market was, hitting new highs during that period of time. But it did give us a big warning signal. Now, with that said, the 2008 financial crisis, the center of that was housing. The tech bubble in 2001, center of that was technology stocks. Will the next recession be based on technology, housing market, maybe something else? The housing market is very resilient these days because we have something called the lock-in effect, where if a period of very low interest rates followed immediately by a period of very high interest rates. So all those individuals that want to sell, they're saying, well, I don't want to sell my house. I mean, the price is good. I don't want to sell my house. I have a 1% mortgage. If I buy something else, I'm going to have a 7% mortgage. I'm going to stay where I am. I'm not selling. So there's, a problem of inventory in the housing markets. And maybe that's why building permits, are declining, or maybe they're acting a little bit differently. But nevertheless, the building, or maybe that's because building permits are not declining faster than they are. Maybe there's a lot more building permits than we would normally expect because the home builders are saying there's no supply. We should build more homes. Maybe building permits would be a lot lower if not for that lock-in effect. Notice building permits hit a low actually before. This looks like late '08, early '09, before the stock market hit a low March of 2009. Building permits had already started to rise when stocks were still going down. That's a leading indicator. Well, we're going to watch this very closely because if we come to the point that we see stock market really start to go down, a lot, we're going to watch building permits. Maybe it'll make an early reversal as well. Now, we can also consider the Case-Shiller Home Price Index. Again, this is on a year-over-year basis. This is an indicator that's more based on present day and not leading indicator. I would say this is actually a present indicator, not lagging, not leading, kind of in the middle. And we see here we hit lows March of '09, right as the stock market also hit lows. We crossed into negative territory mid '07, about a year before the stock market really got in trouble, right over here. Well, we're just barely hanging above zero at this point after hitting very significant highs. Coincidentally, right around the same time the stock market hit very significant highs, the Case-Shiller Index kind of tells us where we are right now, as opposed to some of the other indicators. Now we have the Empire State Manufacturing Index. It's the state of affairs in manufacturing in the state of New York. And this was actually released just a couple days ago. And the report shows us we dipped once again into negative territory. We've been in negative territory more or less on the Empire State Manufacturing Index going back about a year and a quarter or so. Now, interestingly enough, I would say first quarter 2008, we dipped into negative territory and we stayed in negative territory through the brunt of the market crash and only went positive again June of '09, about a year and a quarter. Well, we've already been in negative territory more or less for a year and a quarter. Of all the indicators that we've talked about so far, this probably is the most troublesome because I know that we went positive territory a couple times, but the fact of the matter is we're more in negative territory than positive territory for already a year and a quarter, 5 quarters or so, which is the amount of time, the duration of the financial crisis of '08. Now, that's the state of New York. Just down the road, we have the Philly Fed Manufacturing Index reported yesterday. This, by the way, is now in positive territory for the first time in a while, about a year or so. We dipped into negative territory March of '08 and remained so through mid '09. Present day, we are in negative territory and now we're positive territory. That looks like a similar pattern to what we saw here, except for the fact that we didn't get down to the depths that we were. We were in negative 40, negative 50 territory. Well, actually not that far away. But again, this is only Philadelphia. It's only, I think, the third district in the Philadelphia region. So this is a very small picture of where we are in terms of the economy. And again, the goal of this channel is to very objectively show as many different angles of the economy as we can so we can hopefully give the best, most educated opinion about state of affairs in the economy from the angle of housing and inflation and jobs in manufacturing. And there's many, many more that we didn't talk about today. Auto sales and durable goods and just, the stock market performance and interest rates. And of course, the bond market, which we can never talk enough about. So we hope that through all of these different angles, we can provide the most comprehensive view of the stock market and the overall economy, and to answer that excellent question. What is the best indicator to predict a recession? The answer is they all are, if we can talk about them all in a very objective way. We hope this has been helpful. We look forward to seeing you back soon.